Good day, viewers. Welcome to today's video lecture on capital gains tax. Now, as an individual or a taxpayer, whenever you sell an asset and you make profit on the disposal of the asset, you are expected under the law to remit some percentage of that profit to the government. That profit you made on that disposal of the asset is what we know as capital gains. You understand that? It's what we know as capital gains. So under the law, you are expected to remit some percentage out of that capital gains to the relevant tax authority, that is the Federal Inland Revenue Service. Now, let's look at some introductory aspects about capital gains tax. Capital gains was introduced in Nigeria in the year 1967, but became effective on the 1st of April 1967. The act is now referred to as the Capital Gains Tax, Cap C1 LFN 2004. Now, what is capital gains? Capital gains refers to the profits arising from the disposal of capital assets. That is, that gains that you made on the disposal of capital asset. That is, whenever you sell an asset and you made profit on it. And I said, please note that capital gains is not the same as balancing charge. So there's difference between capital gains and balancing charge. Balancing charge will occur when sales proceeds on disposal of qualifying capital expenditure exceed tax written down value, but capital gains is when the sales proceeds exceed purchase price. What I'm trying to say is, you see the word qualifying capital expenditure, QCE. Qualifying capital expenditure means that those type of assets that enjoy capital allowance. Are you getting it now? So balancing charge is used for capital allowance when computing capital allowance, but capital gains is not. Do you understand me now? Only assets that can enjoy capital allowance that can enjoy capital allowance are those type of assets that you can calculate balancing charge whenever you make profit on their disposal. And mind you, there is limits to the amount of balancing charge that you can record. Under the law, the amount of balancing charge that you can record under the law must not exceed the total capital allowance. If the balancing charge exceeds total capital allowance, then the excess will be regarded to as a capital gains also. Are you getting it now? So let's look at, and capital gains is when the sales proceeds exceed the purchase price. Do you understand now? You see that capital gains is not necessarily for qualifying capital expenditure. Capital gains comprise of all assets apart from those assets that are exempted by law. Do you understand that now? Now, what are capital gains tax? Capital gains tax is the amount charged by the government on profit made on disposal of capital assets in a year of assessment. The rate was 20% between 1967 and 1997. But from 1998 to date, the rate reduced to 10%. So the current rate for capital gains is 10%. Now, what are chargeable assets? Chargeable assets for the purpose of capital gains tax refers to all type of assets, whether situated in Nigeria or not, excluding those exempted by law. They include options, debt, land and building, as well as other type of assets. Now, basis of assessment. The basis of assessment for the computation of capital gains tax in Nigeria is the actual year basis. So the actual year basis is the basis of assessment. Who is liable to capital gains tax? Individual and company, that is, who are those people that are expected to pay tax on their capital gains? Individuals and companies, individual partners in partnership business, that is their partnership business, including their partners, sole proprietors, that is formal business, trustee of a trust, and employee, that is everyone is liable to pay capital gains. So, in as much as you are making profit on the disposal of your capital assets. Now, the next one is, what are those gains exempted from capital gains? That is, even if you made profit on some class of assets, you are not expected to pay tax. Are you getting it now? So the first one is the gift arising from debt. From debt. The second is the disposal of assets sold as a trustee or nominee because you are not the owner. Gains on disposal of government securities, stocks, and shares. Compensation for loss of office is exempted up to 10,000 naira, but the excess is chargeable. That is, if they compensated you, let's say 30,000 naira, 10,000 is not chargeable, but 20,000 naira is chargeable. Do you understand now? Gains accruing from any superannuation pension or provident fund approved by the Joint Tax Board. It must be approved by the Joint Tax Board. Compensation or damages for any wrong or injury suffered by an individual in his person or in his profession or vocation. Number 7, gains accruing from the disposal of an individual only main residence or dwelling house. That is, if that house that you sold is your main residence, that is the only house that you have, and if you sell it and you make profit, government is not going to charge tax. But if you have more than one houses and you sell out of it, government is going to charge tax. Now, what are those allowable expenditure under capital gains tax? When computing capital gains tax, that is, what are those expenditure that government will allow as a deduction? The first one is any cost incurred for the acquisition or provision of the assets, together with the incidental cost of acquiring the assets. That is the cost of acquiring the assets and any other costs you incurred in acquiring the assets. B. The cost incurred for the purpose of enhancing the value of the asset. That is, let's say, to beautify the assets to your taste. For example, if you buy a house and you see that uh, there is no swimming pool in it, you can do swimming pool. So this is part of what they are saying. C. Expenditure incurred in establishing, preserving, or defending the title to or rights over the assets. Then the incidental cost of making the disposal or acquisition of the assets. All those costs that you incur in making the disposal, that is, whenever you decide to sell the assets, all those costs you incurred, and whenever you bought the assets, those small costs. Are you getting it now? Like stamp duties, advertising costs, professional charges, stuff like that that you incurred in disposal of the assets or acquisition of the assets are all allowable. So, in a nutshell, what this allowable expenditure is trying to tell us is that all those costs you incurred in connection to the acquisition of that property or the sales of that property is what will be allowable for tax purpose. Do you understand now? Now, the next will now be the disallowed expenditure. That is the expenditure that will be disallowed, irrespective of the amount incurred. Are you getting it now? Those expenditure that government will not allow as a deduction under the Capital Gains Act. Number one is any expenditure allowable as a deduction in computing the profit or gain or loss of a trade, business, profession, or vocation for income tax. That is, in any other act, if that expenditure has been allowable under any other act before, you have you've deducted it from one income under any other act, it will not be allowable under capital gains tax. The essence of this is that government did not want you to enjoy relief of that allowable expenses more than once. Do you understand now? For example, interest. If you purchase an asset on hire purchase, interest is not interest and allowable expenses under company income tax. So interest again will not be allowed under capital gains tax. Do you understand? Don't worry, we are going to treat some questions on that so that you are going to understand what I'm trying to say. Be any premium or other payment made under a policy of insurance. For example, if you insure your assets under any insurance policy, that amount you paid, the periodic amount you paid to the insurance company, which is known as premium, will not be allowable as a deduction for tax purpose. Are you getting it? Because government feels that it is recoverable. Are you getting it now? Because it is recoverable if the damage occur, they feel it is recoverable. And another thing is depreciation is also not an allowable expenses. Remember when I was explaining the difference between balancing charge and capital gains? I said balancing charge is for those assets that enjoy capital allowance, while capital gains is for all assets. So as you all know that depreciation is the enemy of tax, government don't want it at all in any situation. So definitely depreciation is not allowable also for tax purpose, that is for capital gains tax also. So now the next thing is there are some real life scenarios, transactions that taxpayer usually carry out. For example, if you transfer assets to someone that you know, someone that is very, very close to you, someone that can affect your decision, how will you account for tax? How will you determine the sales proceeds for tax purpose? Because the amount you sold that asset is dependent on the amount that government is going to realize. Are you getting it now? That is, government is depending on your income. So if you make false declaration, it's going to affect the government. So how are you going to determine the sales proceeds if you sold assets to connected person? That is someone that is very related to you. For example, husband and wife, father to son, uh, daughter to his mother. Now, they said when assets are sold to connected person, the sales proceeds for the purpose of computing capital gains tax is the higher of market value and sales proceeds of the asset. That is, if you sell the asset to connected persons, someone that can easily influence your decision, someone that you are closely related to, either directly or indirectly, then the sales price, that is the sales proceeds that government will consider, is the higher of market value. That is the highest between the market value and the sales proceeds. Because government will feel that you won't want to sell it at the true market price. Government feels that you won't sell it at arm's length transaction. That is, the transaction will not be in arm's length. You understand now? For example, if the asset you sold the asset for 200 and the market value of the asset is 300, government will pick 300 as the sales proceeds. You understand now? But let's assume that you sold the asset for 300 and the market price of the asset is 200. Government will still pick 300 because that's the highest. Do you understand now? So they now said in addition, when assets to connect are not sold to connected persons, that is someone that you are not connected with, the sales proceeds will be the actual sales price, even if the market price is higher than the actual sales proceeds. That is, government will feel that you sell it at arm's length transaction, even if the market price is higher than the sales proceeds. For example, if the market price is 200, are you getting it? And the sales proceeds and the actual sales proceeds that you dispose it of is 300. Government will pick 200 because they feel that the transaction is at arm's length because you are not connected in any way. Do you understand that now? So you should understand that if it is connected person, you pick the highest between the market value and the sales proceeds. And if it is not connected person, you pick the actual sales price. Are you getting it now? So computation of capital gains tax. This is the format. So simple as that. So the sales proceeds Remember the rule of connected and non-connected person. Allowable expenditure, that is those expenditure you incurred in connection with the sales of the asset. Are you getting it now? Then this gives us the net sales proceeds here. Then the cost of acquisition, the cost of acquiring the asset, that is all those costs you incurred in acquiring the asset. For example, if it is land or land and building, you bought land, you build on it, you did some fence, you did some decorations in it. So those things are what make up the cost of acquisition. Do you understand now? So then the difference between these two will give us the capital gains. Then you charge the 10% on it. Now, let's look at an illustration. Mr. Hime Hakpan, who resides in Calabar, Cross River State, has many buildings situated in the state. He sold one of the houses to his daughter-in-law for 350,000. You can see daughter-in-law, connected person transaction. Can you see? So he sold it for 350,000 on May 15, 2009. The following additional information was supplied in connection to the building sold. The first one is a cost of construction of the building sold, cost of renovation prior to sales, professional charges in connection with the sales of the property, insurance, fire, tornado of building sold, cost of land on which the building was erected, the market value of the portion of the building sold. Now you see that, look at the market value of the asset. This is the price at which Mr. Ime Akman should have sold that asset to his daughter-in-law. But because of the relationship between them, he sold the asset for 350,000. This means that we are going to use the market value because that is the higher between the actual sales price and the market value. So we are picking market value as our sales proceeds. Now it remains some allowable expenditure. Now this is a cost of acquisition, which is cost of constructing of building sold. This is part of cost of acquisition. Cost of renovation prior to sales is also part of the cost of acquisition. Professional charges in connection with the sales of the property. That is, when you sold that asset, when you're about to sell that asset, what are those costs that you incur? I explained that under the allowable expenditure. So this is the cost incurred in connection with the sales of the property. Then insurance, fire, tornado on building. So this is a disallowed expenses because I've said that in the disallowed expenses when I was explaining it. I said any amount paid under an insurance policy or any other amount, are you getting it, that you use to insure against risk is not an allowable expenses. Cost of land on which the building was erected, 30,000, is also allowable, part of the cost of acquisition. So the so let's look at the solution now. Sales proceeds will be the market value as explained earlier. Then the professional charges, that is the cost you incurred in connection with the sales of the property. With the dot, this gives us the net sales proceeds. Then the cost of acquisition, which are the three that I highlighted here. One, two, that is cost of construction of building sold, cost of renovation prior to sale, and the cost of land. We make up our cost of acquisition. Then you deduct. This gives us the capital gains. Then your 10%, you charge 10% of the capital gains. Then that gives us the capital gains tax. Now, computation of capital gains tax. When payments are received instrumentally, that is, if you sold an asset and the buyer of that asset did not pay all the cash instantly, that is, payment is received in piecemeal. Are you getting it? And the payment is payable, is receivable above 18 months. That's what this page is telling us. So now let's read. If the consideration taken into account in the computation is payable installments over a period exceeding 18 months, then the chargeable gain arising from such disposal shall be deemed to accrue in proportion in the year of assessment until the final installment is paid. That is what the government is trying to tell us, is that if you sold an asset and payment is not received instantly, That is, payment is received bit by bit, instrumentally. Government will not wait for you till you till you receive the final installment before they charge capital gains. So government will be collecting the capital gain small small, that is little by little, in proportion to the amount you collected in any year of assessment. For example, if the capital gains you are expected to collect, assuming the person gave you the full amount, let's assume that it is 10,000. Government will not wait until the final installment is paid before they collect that 10,000 from you. Government is going to be collecting part of that 10,000 each year, each year from you. Now, in order to do that, government also consider some aspects whereby the buyer may not be able to pay all the installments. Under this, the tax authority has the discretion to grant you relief. Are you getting it? It is on the discretion of the tax authority. Are you getting it now? If the tax authority feels that your point is very is genuine, and they feel that you can claim the relief, they will grant you the tax relief, the tax offset, or they will grant you refund of the capital gains tax that you've already paid before. That's on the discretion of the tax authority. It's only them that can decide that. So the amount of capital gains at the end of each year of assessment shall be as follows. Consideration received in a year of assessment times chargeable gains all over total consideration received. So this is the formula to use how to apportion the capital gains that will accrue in any year of assessment. Now let's look at illustration 2. Mr. Ade sold building to Mr. B, which cost 200,000 naira for 450,000 naira. This consideration is not payable in 9 half-yearly installments. The first installment is payable on 1st of January 2009. Required, calculate the capital gains tax payable in 2009 year of assessment. Under this, you see that this is the cost price and this is the sales proceeds. Are you getting it now? So if Mr. Ade received the money in full instantly, capital gains will be 250,000. Do you understand that now? But Mr. Ade is not paying this 450,000 instantly. He's paying it 9 times, half yearly. That is 2 times in a year. 2 times in a year. Definitely, he's going to pay it in 4 years, 4.5 years. Let's say 4.5 years. So the first thing for us to do under the illustration is that we are going to determine the capital gains, the total capital gains. Total capital gains here will be 450,000, which is the sales proceeds, minus 200,000. That's 250,000. Now let's look at how much is Mr. B going to pay instrumentally. Remember, we are using this formula. We are using this formula to determine the capital gains accruable in a year of assessment. Consideration received in a year. So we have to determine how much is Mr. Ade going to pay in a year. Remember, we'll be paying 2 times in a year. And the first payment will be in January, 1st of January. Are you getting it now? So definitely it's going to pay one in January and the next one will be 1st of July. Definitely 100,000 will be received by Mr. Ade in 2009. So now let's use the formula. Consideration received in a year of assessment times chargeable gains all over total consideration received. So this gives us 55,560. That is 100,000, which is the consideration received in a year of assessment, times 250,000, that is the capital gains, then the 450,000, the total sales proceeds. Are you getting it now? The consideration, making 55,560. So 10% of such will give us 5,560. The same thing applies to 2010 because another installment will be paid in 2010, that is 2, making 4. The same thing to 2011. Do you understand now? Making 6. The same thing to 2012, making 8. Remember, you are going to 9. But for 2013, will now be 50,000 instead of 100,000 because the last installment will be paid on the 1st of January 2013. So that will be 50,000 times 250 all over 450. That will also give us the capital gains, then charge your 10% like that. Now, having said that, Let's move on to computation of capital gains where there is partial disposal of property. Partial disposal means that you have a property and part of that property can be sold independently. That is, it can be sold separately without affecting each other. For example, land. If you have 6 plots of land, you can decide to sell one plot out of it, or you can decide to sell half plot out of it. You understand? And that one plot does not affect the other the remaining 5 plots. You understand what I'm trying to say? So let's read. If a single asset which is made up of two or more parts, and each part can be sold separately by the owner are disposed of in bits, the capital gains tax on the asset disposed shall be determined as follows. The sales process of parts sold, that is that part that you sold, remember you are not selling everything, but that portion you sold, you write it down. Cost of parts sold, the formula is A all over A plus B times cost of whole asset. Meaning of this is you are taking the proportion of that asset that you sold out of the whole proportion of the asset. For example, when I use that land as an example, we are going to say 1 all over 6. You understand me now? Times cost of whole asset. Now, where A is the sales process on parts sold, B is the market value of parts unsold. So let's look at illustration 3. Swinger bought a block of 6 flats, for 750,000 naira and spent the sum of 18,000 on construction of swimming pool and landscaping on gardens in the premises. You see that he bought 6 flats for 750 and he spent 18,000 naira to construct swimming pool. Remember, part of those allowable expenditure. Letter B, out of it, I said cost of improving the asset. Are you getting it? Or renovation cost is an allowable expenses. So if you add 750,000 plus 18,000, that will give us 768,000. This gives us the cost of the whole asset, the whole 6 flats. Now, and after 2 years later, he disposed of one of the flats to his brother-in-law for 150,000 naira. You will see that this is connected person transaction. You sold to your brother-in-law. Definitely, you won't want to sell it at the true market value. This is not an arm's length transaction. After ascertaining from the professional valuer that he could sell the flat for 170,000, you can see. Remember the connected person rule. So we are using 170,000 as the sales proceeds. Compute the capital gains or loss arising from the disposal of the asset. So let's go. Since you know that this is a connected person, we are using the market value as 170,000. So the market value is 170,000. Then let's look at the cost of parts sold. That is this. A is the sales proceeds on parts sold, that is 170,000 all over 170,000 plus B is the market value of part unsold. That is, the market value is 170,000. Out of 6 flats, you sold 1 flat. It remains 5 flats. So multiply it, give us 850,000. Then add it, put it here. Multiply by the cost of whole asset. I've explained that earlier. That is 750,000 plus 18,000. Cost of the assets and the cost of doing the swimming pool, making 768. Then calculate to give us 128,000. Then deduct that's 42,000 naira. Do you understand that? So then charge your capital gains tax on it. The next on the line is the acquisition or disposal by a creditor. That is, if your creditor took over your asset, that is took hold of your asset, if you are unable to pay your debt as at when due, that is, if your asset is used as a security, as a collateral. Now let's read. Where an asset is acquired by a creditor in satisfaction of his debt or part thereof, the asset shall not be treated as disposal by the debtor or acquired by the creditor for a consideration greater than the market value. Are you getting it now? That is, the market value of the asset will be the consideration, will be the sales proceeds. Do you understand? Not the market value as at when the debt was incurred, but the market value as at when you want to sell the asset. The chargeable gain shall be reduced so as not to exceed the chargeable gain which would have accrued if he had acquired the property for a consideration equal to the amount of debt. What the government is trying to tell us is that in order to determine the capital gains, there are two scenarios involved. The first is the sales proceeds, that is this first line here. How do you determine the sales proceeds? The sales proceeds will be the market value as at the time of disposal. Do you understand that now? Now, what about the consideration of the property? Is it the market value as at the time of as at the time the debt occur, or is it the amount of debt? Do you understand now? Now that is what this paragraph is trying to clarify there. So the paragraph says that the chargeable gain accruing shall be reduced so as not to exceed the chargeable gain which would have accrued. That is so that the chargeable gain will not exceed an amount if that creditor has acquired the consideration equal to the amount of debt. What they are trying to say there is that the consideration, that is the cost of acquisition, remember we'll be deducting sales proceeds from cost of acquisition. The cost of acquisition here will be an amount equal to the amount of debt. Do you understand? Equal to the amount of debt. Now let's look at an illustration for better understanding. Jide gave his property with a market value of 8,000 naira for a loan of 10,000 from the bank. Jide defaulted and the bank disposed of the security for 20,000. So this is the sales proceeds. But at the time Jide collected the loan, 8,000 naira is the market value of that asset. You understand? But the loan that Jide collected was 10,000. So the sales proceeds is 20,000 when the bank disposes, but the cost of that asset will be 10,000 naira. If you use market value as the cost, the capital gain would have been 12,000. You understand? If you use 8,000 naira as the cost of that asset, the capital gains would have been 12,000 naira. But the government want to restrict, based on that rule, that the capital gains will be restricted to an amount as if the consideration is equal to the amount of debt, that is the cost of that asset restricted to the amount of debt. That's why I said 20,000 minus 10,000. That will give us 10,000 as chargeable gain. For better understanding, you can check this note. If the market value of the assets of 8,000 was used as the cost, the capital gains would have been 12,000. That is 20,000 minus 8,000. But the capital gains will be restricted to 10,000 because the rule says that chargeable gain will be reduced so as not to exceed the chargeable gain which would have accrued if he had acquired the property for a consideration equal to the amount of debt. Now let's look at hire purchase transactions. That is, if you purchase an asset, and at the time you purchase that asset, you purchase it on hire purchase, how will you treat the capital gains? Remember, hire purchase price comprises of both cash price and the interest element. I know that interest is an allowable expenses for tax purpose under the company income tax. Do you understand? Now, where an asset is purchased on hire purchase was subsequently disposed of, the cost of the asset will be the cash price. The reason is because you would have claimed an allowable expenses under CIT as interest, the cash price element of the purchase price of an asset. Remember that purchase price of assets always comprise of both cash price and interest. Hence, interest element in the purchase price should be excluded for the purpose of computing capital gains tax. Now, remember that if you purchase something on hire purchase, you will also be paying instrumentally. Remember, I've done one instrumental payment earlier. the previous instrumental payment that I did, that is here, is when you sold the asset and you are receiving the payment instrumentally. Are you getting it? Here, both the total price of that asset and cash you and the interest that you charge you, government is going to charge tax. But the instrumental payment I'm talking about here, that is on the hire purchase that I'm talking about here, is when, as at the time you purchase that asset, you purchase it on hire purchase. Do you understand? The previous one that I showed you is when you sold the asset and you receive payment instrumentally. Are you getting it? But here is when you sold, sorry, the first one is when you sold the asset and you receive payment instrumentally, while this one is when you purchase the asset then and you paid instrumentally. Remember, your payment will be both the cash price and the interest. So how do we treat that? So let's look at illustration. On 1st of July 2012, Camilla Limited purchased a generating plant on hire purchase on the following terms: deposit 600,000, monthly installment 100,000, interest element in each installment 10,000, period of repayment 2 years. You can see that it's monthly installment, so each year they will be paying 100,000. Remember, the monthly installment will comprise of both the cash price and the interest element. So interest would have been in this monthly installment. So and the period of payment is 2 years, making 24 months since it is monthly installment. On 31st January 2007, the company sold the plant for 3,200,000, incurring costs relating to the disposal of 35,000. So this is cost in relating to the disposal of the assets. Compute the capital gains tax payable by Camilla Limited. So the sales proceeds, incidental cost of disposal, the sales proceeds is 3.2 million. Incidental cost of disposal, that is 35,000, you deduct. Then the cost of acquisition. Remember I said in determining the cost of acquisition, you only consider the cash price of the asset. So the cash price will make up, let's look at the workings. The cash price will make up the deposit, which is 600,000, and the instrumental payment that you make, that is 100,000. If you deduct the interest element from it, gives us 90,000 as cash price, then multiply by 24 months, making 2,160,000. So add the two together, 2,760. So that's what make up the cost of acquisition here. So deduct, then you charge your tax 10% on it. Now let's look at rollover relief. What do we mean about rollover? If you sold an asset and you use that sales proceeds, that is the amount you collected, to purchase another asset of the same class, government will grant you rollover relief. Rollover relief means that you won't pay the tax immediately, but the tax will be deferred. That is, will be payable in another year. That is, whenever you sold the asset, that is when you are going to pay that tax. Do you understand now? Let's assume that you sold the land now. You now use it to buy or purchase another land, and you are making a profit. You are not going to pay tax immediately. For example, if you sold the land in 2010, you are not going to pay tax in 2010. That new land that you purchase again, when you now subsequently dispose that land, let's say you dispose it again, the new one that you bought, you dispose it in 2013, definitely government is going to charge tax in 2013. That's rollover relief. Do you understand that now? So let's read. Rollover relief is granted where the sales proceeds on the disposal of certain chargeable assets is utilized in the acquisition of a new asset of the same class. You see this word, sales proceeds on the disposal of chargeable assets is utilized in the acquisition of a new asset. That is that amount you collected when you sold that asset, you use that money to buy another asset of the same class. For example, if you sold land and you are using that money to go and buy plants and machinery, there is no rollover relief for you. Remember the clause that you must purchase the assets of the same class. You understand now? The key benefit where a rollover relief is granted is that capital gains tax payable may not be paid immediately. It may be fully deferred, or only a portion of it may be deferred into the future. Do you understand now? I've explained that earlier. That is, that tax that you're expected to pay in that current year will be deferred. Government is going to transfer the payment of that tax to that subsequent year when you sold that asset. This gives some cash flow advantage to the taxpayer. This is categorized as another form of tax avoidance. So you can avoid tax. Remember, tax avoidance is not illegal. You are just taking advantage of tax loopholes. You understand? You are just taking advantage of tax loopholes. For example, if you needed money for some vital investments and you are expected to pay tax, you can sell, and you want to sell an asset during that period. And if you make profit on disposal of that asset, you can repurchase another asset of that same class. Are you getting it? And that tax you're expected to pay, you can use it to invest and you'll be receiving some interest on it. Do you understand now? So that in subsequent year when you dispose of the asset, you can be able to have sufficient funds to pay the government. Do you understand now? So I said note for government to grant rollover relief, the proceeds on the disposal of certain assets must be used to purchase another asset of the same class previously sold. I've explained that earlier. Now, not all assets can enjoy rollover relief. We only have this class of assets. So this is class A and this is class B. So this is class A and class B. So class B is B1, B2, B3, and B4. Stuff like that. So these are those assets. So for example, if you purchase motor vehicle, if you sold your motor vehicle to purchase another motor vehicle, there is no rollover relief for you because it is not under this category of assets that can enjoy rollover relief. Do you understand that now? So let's move into the next one. Let's look at the forms of rollover relief. Rollover relief can be in any of the three forms. We have the full rollover relief. This will occur when proceeds from the disposal of old assets is equal to or less than the amount reinvested to purchase new assets. You see, proceeds on disposal of old assets, that amount you collected, if it is equal to the amount reinvested to purchase new assets, that's full rollover. For example, if you sold an asset for 300,000, are you getting it? And you purchase another one for, let's say, 400,000. You can see that you are still adding 100,000 to the sales proceeds so that you can buy new one. This is what we call rollover, full rollover relief. Are you getting it now? So this is what we call full rollover. Or you sold asset for 300,000 and you are purchasing another one for 300,000. It's also called full rollover relief. Under this, no capital gains tax is immediately due because the full payment of capital gains is deferred into some of future dates when newly acquired asset is subsequently disposed. Do you understand that now? So let's look at partial rollover. This will occur when the proceeds from the disposal of old assets is greater than or not equal to the amount reinvested to purchase new assets, or when the original cost of old assets is less than amount reinvested. Now, you see here that when the proceeds of this disposal of assets is greater or not equal to the amount reinvested, are you getting it? To purchase the new asset. If you purchase the new asset for 300,000 and if you sold the old asset for 300,000 and you are purchasing another one for 50,000. Are you getting it now? That is a partial rollover relief. Do you understand now? Or if the original cost of the old asset, the original cost when you purchase that asset, then the original cost, if it is less than the amount reinvested, that is also called partial rollover. Are you getting it now? So, under this, tax will be charged on the part of the capital gains, while the remaining tax will be deferred. Meaning is some of them will be charged now, while some will be deferred. Number three, no rollover relief. This will occur when the original cost, you can see I said original cost, I did not say sales proceeds. The original cost of the old asset is equal to or higher than the amount invested to purchase new assets. So if the original cost of the old asset is equal to or greater than amount reinvested, there is no rollover relief for you. So I will give us a format that will help us to understand rollover relief. This format is very, very useful to the extent that if it is full rollover relief, this the result will tell you that this is full rollover relief. If it is partial, it's going to tell you that this is partial rollover relief. And if it is nil rollover, the result is going to tell you that it is nil rollover. Now, the normal format that we use for capital gains, which is the sales proceeds less cost of sales, that is cost of acquisition. The sales proceeds of the old asset, cost of the old asset, deduct making capital gains. Then if you're applying your rollover relief, you deduct the lower of amount reinvested to purchase new assets and sales proceeds on disposal of old assets. You deduct the lower between these two from the cost of old assets. Then the difference between them gives you the amount rolled over. Then deduct the capital gains from the amount rolled over. This gives you your capital gains liability, the capital gains tax. It's liable to tax. Now, what if when you subsequently dispose that asset that has enjoyed rollover relief, when you dispose of the asset, how are you going to calculate your capital gain? That is what this carrying cost is all about. That takes us to carrying cost of an asset. Now let's read. When an asset on which rollover relief has been granted, the capital gains of the asset is not sales proceeds less cost of acquisition. Are you getting it? The capital gain for this purpose shall be the sales proceeds minus carrying cost. Do you understand? It will be sales proceeds minus carrying cost instead of cost of acquiring the asset. While the carrying cost of the asset is amount reinvested less amount rolled over. Now let's look at an illustration so that we understand these three forms of rollover relief. Shola Limited disposed of its plant for 600,000 in 2007. The plant was actually acquired for 250,000 in 2002. Remember, this is the sales proceeds of the old asset. Sales proceeds. The cost of acquisition. Compute the capital gains tax liability, that's one. Amount rolled over, that's two. And the type of rollover relief, that's three, that occurred in each of the scenarios. So let's look at these scenarios. Scenario one, Shola replaced the old plant within 8 months for 750,000, but subsequently sold for 800,000 in 2010. You will see that this is rollover. The proceeds from this was used to purchase another asset after 8 months for 750,000. He now later sold it again for 800,000. Shola replaced the old plant for 500,000 but subsequently sold for 500,000 in 2010. Shola replaced the old plant for 250,000 but subsequently sold for 550,000 in 2010. So this is the scenario 1, 2, and 3. Now let's solve scenario 1. That's the A aspect. The sales proceeds of the assets of old assets is 600,000 and the cost of the old asset is 250,000. That's clear. That's 350,000. Then applying the rollover relief, you deduct the amount reinvested. That is the amount you used to purchase the old asset, which is 750,000 naira. Then the sales proceeds of the old asset, which is 600,000. The lower between these two is 600,000. You understand? Then you deduct it from the cost of old assets, 250,000. That is this amount. understand? So if you deduct 600 from 250 being the lowest, 600 from 250, that's 350. Then the lower, this gives you amount rolled over. 350 gives you amount rolled over. Definitely you are rolling over all 350,000. You see that the capital gains is nil. This is what we call full rollover. No capital gains tax will be charged. Are you getting it now? Now let's look at how when Shola Limited sold the assets, subsequently sold the asset in 2010. Remember I said if you sold an asset, the capital gains will be sales proceeds minus carrying cost, not sales proceeds minus cost of acquisition. And carrying cost means amount reinvested, which is 750,000, minus amount rolled over, which is 350,000. That is amount you roll over 350,000. You understand? And amount reinvested, which is 750,000 naira. So the deduction of this gives us 400,000, making 800,000 minus 400,000. That's 400,000. In another case, or alternatively, you can also do it like this. The first one, remember you are making a capital gains tax, capital gain on the first transaction. When you sold the asset in 2007, you make capital gains of 350,000. That is 600 here minus 250, making 350,000. So if we charge 10% on 350,000, that will give us 35,000. Are you getting it now? And the second transaction, you also sold the new one that you bought. Remember you bought the new one for 750 and you sold it for 800, making 50,000 capital gain. So if you charge tax of 10%, that will be 5,000. So the addition of the two gives 40,000, same as what was computed here. You understand? So you can also solve it like this. But the most important thing is that just make your answer, your calculations look presentable. Now, then I got my 400,000, so you do your 10% of 400,000, making 40,000. Let's look at the scenario two when Shola replaced the whole asset for 500,000, but subsequently sold for 500,000 also. So let's look at that aspect. Scenario 2. Sales proceeds 600,000, cost of old assets 50,000 as like previous one, the previous scenario we did. So rollover relief, let's deduct lower of amount reinvested. Remember you purchased new assets for 500,000 under the new scenario, under the scenario 2. And the sales proceeds of the old assets is 600,000. So the lowest is 500,000. Deduct 500,000 from the cost of the old assets will give us 50,000. So 350, 250 is the amount rolled over. Definitely you are not rolling everything over. You are only rolling 250,000 over out of this 100, out of this 350,000. So 100,000 is not rolled over. Do you understand that now? So definitely the capital gains tax here will be 10% of the 100,000. This is what we call partial rollover. Remember I said under partial rollover, part of the capital gains will be taxed and part of it will not be taxed. Do you understand that now? So let's look at the capital gains tax, how to compute capital gains tax when they subsequently disposed the assets of under scenario 2. So under scenario 2, remember I said sales proceeds minus carrying cost is the capital gains tax, or how to calculate capital gains tax on asset that has previously enjoyed rollover relief. So 500,000 minus 250,000, and how do I get that 50,000? The 50,000 is the carrying cost, which is the amount rolled over minus, amount reinvested minus amount rolled over. That's 500,000 minus the amount rolled over is 250,000. So deduct, then input it here. That's 250,000. Then 10% of 250,000 gives us 25,000 naira. Do you understand that now? In addition to that, alternatively, if you use this method that I apply here, you also get the same thing. So 600,000, the first capital gains we made is 350,000. Then if you charge tax on this, do you understand? On this 100,000, remember you've charged tax on this 100,000, that's 10%. Then the remaining one, which is, remember at first, the capital gains, total capital gains is 350,000. If we charge tax on it completely, 10% of 350,000, that will give us 35,000 naira. Are you getting it? But when you purchase the asset for 500,000, you also sold it for 500,000 again. Definitely no capital gains tax, no capital gains here. Definitely the amount of capital gains you are going to charge will be the 10% of 350,000 naira. But it's just that the 350,000 naira will not be paid in 2007. Are you getting it? Only 100,000 of it will be paid in 2007, while the remaining one will be paid in 2010 when the asset was finally disposed of. Now let's look at scenario 3. Scenario 3, you see that Shola replaced the old asset for 250,000 but subsequently sold for 550,000 in 2010. So the scenario 3 is Shola replaced the old plant for 250,000 but subsequently sold for 550,000 in 2010. So let's look at the solution. The sales proceeds 600,000, cost of old assets 50,000, then capital gains based on the two previous scenarios we've done. So applying the rollover relief, amount reinvested and sales proceeds. So the amount reinvested is 50,000. That is the amount used to purchase the new asset. The sales proceeds of the old asset is 500. Sorry, it's not 500. It is 600,000. It's 600,000. Sorry for that mistake. So the lower between these two is 50,000. 50,000 minus 50,000, that's nil. Then we have, so there is no amount rolled over. So this is the capital gains that we are going to charge tax on. Now another thing I want us to notice is that what if the amount reinvested to purchase the new asset is 200,000? You see that you want to deduct 50,000 from 200,000, and this is going to give you negative figure. Do you understand? Don't include negative figure in the amount rolled over. You can't roll over negative figure. The worst amount that you can roll over is nil value. Do you understand that now? So under no circumstances will you have negative amount for rollover. Do you understand? This will occur if the amount invested is lower than the cost of old assets. Do you understand that now? So that's about that. So here you see that this capital gain 350,000 is the amount of capital gains here also. So this is what we call no rollover relief. So in 2007 year of assessment, capital gains tax will be 10% of 350,000, making 35,000 naira. Do you understand that now? Remember that the asset was subsequently disposed of. The asset was subsequently disposed. So how do we treat that? Remember there is no rollover relief in this scenario. So, and the formula for determining the sales proceeds will be the sales proceeds, the capital gains will be the sales proceeds minus cost of acquisition. That will be 550,000 minus 50,000. That will give us 300,000. Then you charge your capital gains tax. Definitely another 30,000 will be charged in 2010. In addition, you can also use that carrying cost rule. If you use the carrying cost rule, you also get the same 30,000 here. That is the sales proceeds minus carrying cost. And you know that carrying cost is amount reinvested, which is 250,000 minus amount rolled over. Remember, amount rolled over is nil. So if you say 50,000 minus 50,000, which is the carrying cost, it still give you 300,000. So this is just all about uh, capital gains tax. You can consult as many textbook as you want, but I've give you the breakdown of what capital gains tax is all about. Please subscribe to my YouTube channel so that you receive more videos when I upload them, so that you'll be the first person to see my videos, because more videos are coming on different courses, be it financial management, performance management, financial reporting, and so on. Even operational research, there are videos coming on that. Just stay tuned and stay blessed. Just subscribe to my YouTube channel, and if you have any question, feel free to click on the comment box. And in order to subscribe, you see a signal, a bell button. It is free. It does not cost you more. It does not cost you any money. It is free and does not take much